Good afternoon. I'm Mario Becker, founder and CEO of Das Family Office, an MAS-licensed Singapore-based multifamily office. Apart from providing overall multifamily office services such as fund management, trust management, organization of comprehensive wealth solutions, we're also providing very easy to understand simple asset allocation solution where we help our clients and other accredited investors to find easy to understand color-based ways to build their portfolios and help them execute through low-cost platforms which we offer and provide advice on. In the following video, I'm summarizing the first quarter events and I'm referencing Reflections, which is our quarterly update document, which is linked below this video. At the same time, you will also find links to our website, dfo.sg. And for non-accredited investors, we have a partnership with an organization in Germany called vermögensberatung.de, where we also provide a link. The German organization can only offer access to clients from Europe, Australia, New Zealand, Japan. Nevertheless, they give access to a lot of residents in a lot of countries, so please take a look. I hope you enjoy the video. The first quarter in many ways followed the fourth quarter of last year, so it was very good in the equity markets. The dynamic trends in Asia continued, especially Hong Kong and China. But overall, equity markets have been quite strong. Where we saw a major change, and all of that started around mid-February, where a certain sentiment set in that the vaccination efforts in Israel, UK and US are actually working. We saw a change in sentiment and a feeling amongst market participants that there will definitely be a recovery, which ultimately will also require an adjustment in long-term interest rates. We have therefore seen an adjustment in the 10-year Treasury from just below 1% all the way up to about 1.75%. And this was the most dramatic movement in the 10-year Treasury since pretty much the early 80s. And as a result of that, bond markets, investment-grade bond markets suffered, and to a certain degree also emerging market bond markets. The only fixed income area that was safe were high-yield bonds, and to some degree Tier 1 capital preferred securities. Maybe as a rule of thumb, you could say that if there's 1 percentage point increase in long-dated interest rates, a 10-year Treasury will fall by about 7 points in value. Longer-dated bonds, such as 30-year Treasuries, will suffer even more, and they've sold off towards 18%, which was quite significant. The only bonds, or let's say government bonds, that were safer were very short-dated Treasury bills, but even those saw small price fluctuations and saw some losses, which is quite disappointing because we expect the purple, blue, and green building blocks to do very well and establish safety in a portfolio. So the first quarter this year was one of the few quarters that show that sometimes equity markets can actually be safer than bond markets. It doesn't happen a lot, and I would argue that whoever now holds too many government bonds, which fortunately not many of our clients do, this should sort itself out within a couple of quarters, maximum maybe 1.5 years. But I think there's good reason to believe that this will only be book losses, temporary losses, not long-term losses. On the other hand, equity markets did very, very well, and the fact that there is a belief that the global economy will recover also is very, very positive for certain cyclical market areas. And as a result of that, we've seen almost a bull market in small capitalization stocks and cyclical company stocks and so-called value stocks. For the longest time, there have been market participants calling for recovery in value stocks. And finally, this could have happened. At least in the first quarter, there was a major adjustment to the upside. So all of our clients who've been buying into our dimensional balanced portfolios, they're really smiling this time, because last year this area was lagging a bit. but this year it's looking really, really good. All the other strategies on, let's say, MSCI World level, they're doing also very well. We've seen basically mid 5 to 6% price appreciation, which is already significant, given that long-term returns in globally diversified equity portfolios are somewhere between 7 to 9%. So it seems that 2021 could be a good equity year. What I would caution on is style changes. Yeah, last year we had basically a strong interest in these so-called stay-at-home stocks, technology stocks, highly profitable company stocks. And this year, these segments have lagged a bit, not much, but a little bit. So there may be some of you inclined to now switch out of these stay-at-home stocks into value stocks. I would advise against this, because in the long run, all the strategies, be it the quality strategy, be it the value strategy, and be it the market neutral strategy, i.e. just buying the global index, should do well for you, and you should be able to collect the long-term equity risk premium of about 6 to 8%. So please don't do that. Stay the course with the strategy that you have defined, a strategy that is based on your cash flow needs, on your investment goals. And apart from that, I would like you to take a look at Reflections. We spend a lot of time and effort preparing the data. As you know, we always make high quality, low cost solutions available. They tend to not change a lot because we believe in staying the course in all aspects, be it manager selection, be it a decision whether or not we like an index or an active manager. It's more important to really create a portfolio that suits your needs, that fits your personality. And if you found that way, stay with it. I hope you found our summary of the first quarter quite useful, and we're looking forward to post much more in future. If you want to stay in touch with us, then just give us a like and subscribe to our channel. I wish you all the best for the second quarter. Stay safe, stay healthy, and good vaccination progress for all of us. Thank you very much.